We'll keep getting you excerpts of those conversations through the course of the day, but with that, we'll move on now. The RBI has issued a discussion paper that seeks to move banks towards an expected loss approach with respect to bad loans. What does this mean for listed banks? Lata is joining us to explain all of that. Lata?
Well, currently, banks provide loans after you incur a loss. After the money doesn't come back for 90 days, that becomes a bad loan. Now, what the Reserve Bank is proposing is that when there is a feeling of default itself, you start providing. That is expected loss. This is already in vogue in the US and in Europe, and of course, even in India. For NBFCs, there is an expected credit loss provisioning. Now, what does the discussion paper, which was issued by the Reserve Bank on Monday, state? It says banks have to classify all their loans into 3 stages. Stage 1, Stage 2, Stage 3. Stage 1 are all standard loans. Stage 2 and Stage 3 are where you are expecting credit loss. You know, even now, when a loan is delayed by over 30 days in repayment, it's called SMA-2. If it is SMA-1, if it is delayed by more than 60 days, it's called SMA-3. Those will probably come under these expected loss Stage 2 and Stage 3. How much you have to provide will depend. The banks have to decide themselves. They have to create a model. And this, you know, there will be company-specific factors, like one instrument of that company which is floating in the market has been downgraded from, you know, AAA to AA or from AA to A. You know, that could be the factor. The other could be commodity prices could crash. That could be an expected loss. Or there could be macro deterioration. The banks decide for themselves, but they have to independently validate their rules. And the Reserve Bank will also provide guidelines and a floor so that there is some uniformity between banks in terms of how they calculate and provide expected loss. Now, what is the impact on banks today which are listed? It incidentally doesn't apply to cooperative and regional rural banks, only to scheduled commercial banks, most of which are listed. Now, there is no immediate impact because now they've invited comments, the discussion paper, then a draft will be issued. And then for the final rules, they will get 1 year to prepare for it. So it's not an immediate impact, but it is likely that there will be higher provisions because the loss has to be calculated on probability of default. So last 10-year experience could be taken into account, and therefore there could be higher provisions. The Reserve Bank itself in the discussion paper says that there could be a capital shock. Means you're going to report less profit, so less goes into the capital. So there will be a capital shock, and therefore we will give 5 years for the banks to recoup their capital. All this language gives the indication that this is a sword that is likely to hang on banks. There will be time, but for the moment, if everybody was expecting a 10-year great run, there is a small hiccup.
Okay, that is an important update. And Lata, thank you so much for explaining what this